The suspension of tariffs on Canada for a month, while intended to ease tensions, has created new complexities in the trade relationship. This situation has also presented opportunities for other global actors, notably China. China, itself facing tariffs, has been actively pursuing access to Canada's oil and natural resources. Since the completion of the Trans Mountain Pipeline expansion, oil tankers have been regularly departing Vancouver for refineries in China and Japan, marking a significant shift for Canada, which has historically focused its oil exports almost exclusively on the United States. While the previous administration's tariff threats highlighted the risks of this dependence, the success of the Trans Mountain expansion has fueled Canada's ambition to diversify its energy export markets. China and Japan have been competing fiercely for Canada's oil reserves. China's interest lies in increasing its own reserves and exploiting the trade tensions between Washington and Ottawa. However, Canada has made a surprising move, prioritizing Japan over China for its energy exports. This decision forms the core of our discussion today. We will analyze why Canada chose Japan over China in this context, and we will explore the broader implications for the international economy. Alberta, Canada's primary oil and natural gas producing province, is seeking alternative export routes due to U.S. tariff concerns and is actively working to bring Canadian LNG to Japan. Alberta's Environment Minister has met with industry representatives in Tokyo to discuss these energy exports, emphasizing the importance of Canadian LNG for Japan's energy security and highlighting its role in reducing emissions as Japan transitions away from coal. These statements suggest that Canada anticipates its first LNG export project to Japan this year. Canadian officials have attributed this shift to U.S. tariff practices, explaining that they have been compelled to broaden their export markets in anticipation of future tariffs. The Alberta minister also noted geographical advantages, stating that the Alberta-Japan route is significantly shorter than the U.S. Gulf Coast-Japan route, while further claiming that Alberta presents less geopolitical risk. Currently, Alberta is working on multiple projects to increase export capacity. Japan has expressed its enthusiasm. Japanese officials have confirmed their anticipation of receiving LNG shipments from Canada. This represents a lost opportunity for China, which considers oil and gas supplies crucial. Canada's decision to partner with Japan is likely a significant disappointment for the Beijing regime, especially given that the LNG agreements were reached shortly after discussions with China. Furthermore, economic experts suggest that Canadian LNG exports to Japan may be tariff-free. As Alberta increases its engagement with Japan, the U.S. administration may be attempting to secure Japanese support for an Alaskan LNG export project, but this may be too late. Canada appears to have made its decision. If an agreement on LNG and other energy resources is finalized between Canada and Japan, the U.S. stands to lose significantly. These potential losses for the U.S. include reduced Canadian exports of oil, gas, and electricity, which currently bolster U.S. energy reserves, lower consumer costs, and support U.S. goals of expanding international energy exports. The deep North-South integration of North American energy infrastructure means that diversification efforts away from Canada will be costly and time-consuming. The U.S., despite being a net exporter of oil and natural gas, aims to assist Europe and Asian allies by meeting growing domestic demand. Canadian energy production could contribute to U.S. supply through integrated pipelines and grids. This could give the U.S. a boost for exporting oil and natural gas to its global allies, without raising domestic prices, a key priority. Canadian crude oil imports now constitute 24% of total U.S. oil consumption. Cross-border pipelines deliver heavy crude oil to U.S. refineries designed for that specific type of oil. Moving away from Canadian heavy crude poses geopolitical risks, high refitting costs, and dependence on alternative sources, such as Venezuela or the Middle East. The Trans Mountain Pipeline expansion has tripled Canada's oil shipping capacity, enabling its oil to support allies like South Korea and Japan, relationships that have been strengthened by the recent trade tensions. Regarding electricity, while the U.S. generates most of its own, Canadian sources contribute significantly in several states. New projects, such as a power line to New York City, aim to meet a significant portion of the city's electricity needs. With numerous cross-border transmission lines, Canada is vital for grid security and potential generation. The growth of technologies like artificial intelligence is expected to sharply increase electricity consumption in U.S. data centers. A tariff dispute could disrupt these plans. Canada contends that it will not be as negatively affected as the U.S. because of its new relationships in Asia. However, there's an urgent need for Canada to realign its economic interests with the U.S. The U.S. can manage self-sufficiency, but it will be a more challenging and costly path. The changing economic and geopolitical landscape requires cooperation in key areas of mutual benefit, with the U.S. playing a crucial role. Convincing Washington of this need is critical, especially given the weaponization of resources by non-allied actors. Canada also faces internal challenges. New election commitments propose tariffs on electric vehicles and changes to electric vehicle rebate programs. A resource-driven strategy requires significant new infrastructure, dependent on a stable regulatory environment and reliable pricing. In summary, tariff tensions have created problems for both countries, and actors like China pose a risk. The Canada-Japan energy deal has the potential to reshape dynamics between Washington and Tokyo. Thank you for watching.